Ah, yes, the disclaimer. I'm a financial advisor, but I'm not your financial advisor. And if the person that wrote the post is reading this, this is not advice. This is just my thoughts about the post. None of this should be considered investment, financial, tax, legal, or any other kind of advice. Really, nobody should do anything based on anything that I say here. This is for entertainment only. All right, trying something new. Trying Reddit slash r slash personal finance, and I came prepared with a strong drink. Start with one of my favorites. There's actually nothing wrong with this post. Tax returns and getting in advance. Saw a Jackson Hewitt commercial. Please do not take an, and this is advice from the poster. Please do not take an advance on your tax returns if you do not already know this. The APR is really high. If the APR is really high, you probably shouldn't take an advance on your tax refund. Tax return is the name of the thing you file. Tax refund is the name of the money you get if the government owes you money. Please get it right. All right, this next one, annualized 6 to 8% returns question mark. I've always heard that the average 6 to 8% return in the market. Today I was looking to find out how the indices are calculated and came across this site. Full disclosure, I have nothing to do with this site. It comes up as and that's oddly specific and a weird disclaimer. What surprised me is that for the life of the S&P, the returns have been around 2%. There's no way that's right. There's like a 0% chance that that's right. The dividend payments over the life of the S&P 500 might have been 2%. And then he runs the number for some periods. Both of the above are inflation adjusted and include, okay, so they're inflation adjusted. So they're already brought down somewhere between 2 and 4%, depending on the time period. The eye opener for me is this: dividend reinvestments are key. Some stockbrokers don't make it easy to reinvest dividends. Well, it's not really that key. I mean, yeah, you need to reinvest them, but they don't need to be automatically reinvested in literally the same thing. As long as you're not letting the cash build up for years and years, it doesn't really matter. How did he get S&P returns have been around 2%? Let's click it. Okay, here he is. I assume this is what he used. Starting months, do January of the first year. Ending month, I think this 2018 is the latest year we have. Calculate. Annualized S&P 500 return. 4.3%. That's not 2. I guess he was adjusting for inflation. There's his 2.2. Okay. So he's got 2.2. And he's got the average dividend return. Adds 4.5% to that. And the average inflation was something like 2%. That makes sense. Nobody means average after inflation returns when they say 6 to 8%. So I guess good that he's learned something. Scammed into buying cash value life insurance. Now what? All right. Scam is probably the wrong word. But cash value life insurance is usually a terrible investment. I'm 65. Didn't have as much knowledge about investing until recently. You probably still don't. I trusted a financial advisor to take care of assets. He put a bunch of money in an annuity, which turned out to be fine. Okay, I'll trust you. He also opened a cash value life insurance. The sentence doesn't really make sense. With a $40,000 premium in 2015. So far, I have paid $160,000 into the policy. If I closed it now, I would only get $60,000. Are you sure? That's crazy. How much life insurance was there? I'm thinking about just cutting my losses. Really, you've paid $160,000, and if you surrendered it, you would get $60,000? That doesn't seem right. I'm sick of the life insurance scam. I'm kicking myself for trusting the guy. Any other suggestions for getting maximum return? Usually, once you put money into life insurance, it's too late. If you're trying to be efficient, you're going to surrender it. There's not anything smart to do. Sometimes the surrender penalties are what's making it worth a lot less. You just wait, but that doesn't even seem right. Is boyfriend's baking plan harmful? I just clicked it because I like the title. My boyfriend is a bit fearful of keeping all his money in one place in case it's stolen or the bank freezes it. Is he dealing drugs? Is he doing something illegal? Stolen from a bank? He has an incredibly complex banking setup. He has his paycheck direct deposited 50-50 to, okay, there's nothing wrong with splitting it between two banks. I wouldn't do it, but he then transfers most of the money from those two accounts to two separate. Okay, that doesn't make any sense. From there, he sends a portion of his money to two separate banks. What? I don't think it puts any black marks on him. I think it's just a pain in the ass. I wouldn't do that. That sounds terrible. I would simplify that. I mean, is he in the United States? So you got FDIC insurance. Just keep it at a big bank, whatever one you're comfortable with. You know, you could even just keep it in a. You could use a brokerage. It doesn't matter. It seems crazy, but it doesn't seem like a problem. Need some opinions on whether to buy or rent. All right, I won't bother you with all the details. The only thing you need to know, after her grad school is up, there's a good chance we would want to move again to a city with a better job market for her. It's really likely you're going to move. Buying a house probably doesn't make any sense financially. You're going to have to pay 6 or 7% to a realtor. And really, I mean, that's happening on both ends of the transaction, whether you're actually the one footing the bill or not. And it comes with so many more things that you have to do. Something breaks, you have to fix it. So much more liability. It's so much more expensive in almost everywhere. Oh, it's in Urbana. That's what I went to school there. Really, what you should do is look at the type of house that you want to buy and then how much it would cost to rent a comparable house. Probably, if you're factoring everything in right, renting will be a lot cheaper. Would you be totally wrong to buy? No, but that's where most of the horror stories come from. So I would think twice. Need advice. Newlyweds with apparently different outlooks on finance. Been together since high school. We just got married. Congratulations. Luckily, we didn't have to take on any debt thanks to my mom helping us with the wedding, I guess you mean. That's nice. We do okay. You have some student loans, a couple of cars, a tiny bit of credit cards. That's fine. Finances are still separate. For whatever reason, my wife doesn't want to share our finances yet. She can be an impulsive spender and doesn't have the best spending habits. So when you share finances, does that mean like see every dollar that everyone spends, or like you don't know what she makes and if she has any debt or not? That's like kind of a red flag. My wife doesn't want to share our finances yet. Unless she just wants to like keep her own account and not have you bother her about it. Are you the kind of person that's going to harass her for every dollar she spends? Either that or it's a pretty big red flag. How to find a good tax advisor? That's a good question. It's really hard to find a good CPA. I don't have a particularly complicated situation, but I want to go over my retirement, college savings, health savings, employer stock grants, etc. with someone to be sure I'm not leaving money as the table. I'm at a loss for knowing where to... Okay. And also, anyone know what ballpark I should be expecting as far as costs? Good tax advice usually ends up costing a couple $1,000 a year. It's probably more than you wanted to hear. But that's usually about right. You look for someone they're going to have to be a CPA or an EA, an enrolled agent, to file your taxes for you. So you're probably looking, and really, if you're doing employer stock grants, it's going to be a CPA. CPA could also have a CFP, and this first answer is really good down here. CFP designation, or what's called CPA PFS, personal financial specialist. They would probably be able to do both, although I agree most CPAs probably aren't very good at retirement planning. Usually they're focusing on the next 1 or 2 years, not the next 10 or 20. And then, although I will disagree, for a CFP, look for someone who charges a flat consultation fee as opposed to recurring AUM. Sure, if you can find it. Almost no financial advisors charge flat consultation fees. Those are really, really rare. Probably does make sense, though, if you're looking for help with your investing and your planning, to find someone to do that, and then someone to do recurring, really the tax planning for that year, and then filing your tax return for you. How to pay taxes. Working my first job ever. Filled out W-4. 25% is being withdrawn. He means withheld. And I assume that's the correct amount, but at the time I wasn't sure exactly how much I would make. How do I find out if I paid too little or too much? This first answer looks pretty good. Yeah. Like this guy says, if you didn't work at all for the first half of the year, and you said this is your first job ever, so you probably didn't, then there's probably nothing else you have to do. You're probably over withholding, because usually the program's calculated based on a whole year of work. So you'll be in a much lower tax bracket than you're guessing. Also, you're usually in what's called safe harbor, as long as you're withholding more, and sometimes it's a lot more, but more than what you withheld the year before. And I assume you are, since again, this is your first job. And so you might have to pay some extra money in April. I don't know, make sure you got a little bit set aside, but you probably over withheld. Pay off all debt, then save for a house, or pay down, then save. I don't understand. Pay down payment, then save? That's confusing. My husband and I want to sell our current house and upgrade. The bad choices in the past few years have left us in debt. We'll be needing extra space in the future. So although our current house fits our needs, it soon will not. Oh, 117K, and it'll be listed for 166. That's more than 20%. The listing is 10 to 12 months away, so that may change. Our cars are paid off. Student loans are paid off. We have a combined income of 83K per year. You have 38K in credit card debt. Okay, that is really bad. Why would you pay off cars before you paid off whatever? It was much lower. Husband went crazy. All right, I don't even need to read anymore, because anyone that has problems with debt and has credit card debt should not be doing something that takes on more debt. So that's going to be the answer to the question, is you should pay it down. He was also, and you should suck it up and live in the current house until you pay off the credit card debt. He was also making some late payments because he wasn't remembering to pay bills. Well, you can just set them up. It's 2019. You can just set up auto payment. I thought the higher amount of credit. Yeah, okay. Your credit scores are 600. Yeah, okay. My big question is, should I stick with paying off all of our debt, then saving for a down payment? Yes. Yes, you should. Yet you should, and you shouldn't buy a bigger house until you pay off the debt. I want to borrow $15,000 over an 8-year period. I get an annuity every year for the next 8 years. What I'd like to do is borrow the total and pay back what I get each year. I do not want to pay back more than $16,800. That is extremely specific. So whoever I borrow from would get back a profit of $1,800. I wouldn't start paying off the loan until my next annuity payment. Yeah, well, that's you're not going to find that. Sorry. Both my 401k and my Roth IRA are invested in target retirement funds for the same year. Which should I prioritize? All right, I think I know what you're asking. According to the Prime Directive, what is the Prime Directive? Is that like a personal finance thing, / our personal finance thing? If my employer offers a good 401k, I can swap steps 4, contribute to an IRA, and 5, save more for retirement. I think my plan qualifies. I want to say my 401k since it has lower fees due to it being an institutional class. All right, here's the deal. They probably have about the same fees. You should be able to find like whatever you're buying. Well, I guess you know exactly what it is, and it's the target date funds. If you know what all the fees are and they're lower, and you have the option to put them both into a Roth or not a Roth, and you might, or the 401k might only be traditional, then you should just take the lower fee one. Most people don't know the difference between a Roth IRA and a traditional IRA or a traditional 401k, which is the way that taxes work, which is why, if I were you, and what's the institutional? Isn't it $10,000 now? So you should be able to max your whatever. Neither here nor there. You should be able to get into the institutional fund pretty soon for the Roth. So it shouldn't really make a difference about the fees. The difference is the tax treatment. So money that you put in a Roth, you don't get a deduction for that year. You already paid taxes on it, and the idea is you never pay tax on the money again. When you put into a traditional 401k or IRA, you get a deduction that year, doesn't count for your income, but when you spend it, when you're retired, then you pay income taxes on it. So the question is, are you going to be in a higher tax bracket now or then? If you're going to be in a higher tax bracket now, then you want to use the traditional 401k and defer some of the taxes. If you think you're going to be in a higher tax bracket when you're retired than now, you should pay the taxes now. So if you're really early in your career, you're making $40,000 and you'll be making 140 for most of it, and retiring spending more than that or having taxable income higher than that, max out the Roth. I'd say generally it's harder to get money into Roth vehicles than it is to get them into traditional vehicles. So it probably makes more sense to max out the Roth first. I don't know. Sort of depends on the situation. I'd probably split them up. But I would split them up. That's what I do with my own. But you should decide based on the taxes, probably not the expenses, although you consider them. What's the difference? Like 3 basis points?